Good afternoon, everybody. This is Jim Kenny for OptionProfessor.com and the weekly market update with regards to today's date. It is June the 14th. And as I say at the beginning of every broadcast, past performance is not necessarily indicative of future results, and there is a substantial risk of loss in short term trading and option trading. So do consult your clearing firm, your broker, your financial advisor, and all other good sources before you entertain any idea on anything. Okay, quick background on myself, new listeners. I'm Jim Kinney, graduate Boston College, and I have been in this investment arena now for decades. I've done hundreds and hundreds of seminars throughout the nation. Teaching thousands upon thousands of people the uses and the risks of options, using them for both limited risk speculation as well as cash flow creating strategies, and also hedging, using them to protect yourself against market decline. So today I gave a little quick update on Wednesday of this week because I thought the market was at a point where you might want to keep an eye on it and things could be changing. But now here's a regular Friday broadcast. Now, remember, if you have any friends or associates who'd like to listen in, just go to OptionProfessor.com, get the link, and then you're in. If you have any questions, simply email optionprofessor@gmail, and you'll be able to get me. That's singular, OptionProfessor. All right, let's get into it here. We have got some numbers out today on factories and the consumer, and they weren't too shabby. So obviously, the fire alarm that people have been setting off might have been done a little prematurely. I mean, this idea that they're going to cut at next week's meeting or in July may very well be premature, and it might not be until after the third quarter when they actually do something, which would be in the September and then December timeframe. The reason for that is because the numbers are really not justifying any panic right now. I know there are some things out there. You know, Morgan Stanley came out with some report on consumer, business feelings. Some kind of sentiment indicator that did hit a lower level for many years. So that was obviously a negative. But these indicators here, there, and everywhere, they're going to change, and they may not be a true sign of what's going on. Bottom line is the stock market still within a couple of percent of its high. Unemployment still at 3.6%, and the retail sales numbers are showing the consumer still out there spending. So the panic button doesn't seem appropriate, but we'll see next week. If he starts dropping them out of the blue like that, it'll be interesting. Again, the market has already discounted quite a bit of a market of cuts in the market. You've gone from 3 and change on the 10-year down to 209. That's already dropped quite a bit. So that's already discounted quite a bit of any kind of cutting. So I don't know if cutting is going to change the world as much as people are trying to make it out to be. The other thing that was important that I brought out this week is historically, when the Fed does, when they stop tightening or raising rates, within a year they generally do the easing thing. Only one time did it take over a year, and that was 2007. With the results of 2008, they may not want to play the game of wait and see. But the more important thing is in the last two cycles where they did ease, September 18th, 2007, January 3rd, 2001, the results were minus 20% a year later on stocks, and 1 year return on 2001 after they started their tightening, easing, was minus 14%. So the results in the last two times they've done it were not very good for stocks. Now, prior to that, and that's why everybody's holding their hand on this 1995, 1998 thing, is the numbers were good. They were up about 20% both years, both times. So obviously, everyone is hoping that this is 1995, 1998, and not 07 and 01. Well, we've had a very big run up. So, I would think that some of the parallels would be more towards 0701 than they would be 95, where it had not run up through the roof. Actually, it ran up through the roof after 1995, 1998, culminating in that 2001, where they had to start easing again because of the crash that was going on with the .com. At any rate, we're going to go around the horn here, and again, I'm going to put the S&P up here. We were down a little bit on the Dow, and of course, Broadcom came out and of course, they said that their revenues are dropping, and not only that, they're forecasting they're going to drop even more throughout the rest of the year. Now, that's a big, big company, and that's obviously not the greatest news, particularly for semiconductors and the tech sector. So Nasdaq was down a little bit more than the Dow was today. There's a lot of people sitting on their hands. Got that Fed meeting next week. You got the Euro, the ECB doing some stuff, and you've got the G7, G20 meeting, G7, whatever it is, with Xi and Trump getting together, maybe. But like Wilbur Ross was saying, it's highly unlikely that they're going to have a meeting and a 2,500-page agreement is going to be gone through. So it might just be like many of these meetings, more of a photo op than anything else. We'll have to see. But I'm going to show you some of the things that I'm looking at and give you a little idea of what I'm seeing. The big news here this week seems to be the price of gold taking off a little bit. I'll get to that in a minute. We only got 30 minutes here, so I've got to get cooking. All right, so S&P, where are you at? 2886. What have I been saying? Well, let's see. I've been saying that at 2350, when it dropped down there, that it was way oversold, and that the moving averages were 2750, and we could snap back towards there. Well, we did that very quickly. Then when we got up here, I thought that the former highs around 2950 would be the logical place that it might go to. That's exactly what happened. Now it's rolled over back down to 2725, also a former low, and now it's back up to 2900. If we can't take out this 2900, and you can see resistance right there, if we can't take out this 2900, 2950, and these earnings come out not that good, and this thing at with the China and Trump meeting is just a photo op, and the Fed doesn't cut interest rates, there could be some vulnerability here. So I don't think it's off the cards to say this is not a bad time to learn about how to protect gains that you've got, and try to learn a little bit about hedging, where you take a position, say, with the options, and maybe do something like a collar position, where you combine covered call writing and put buying. Or maybe you look at a married put. If you're up a lot on the stock, why not donate a little bit of money out of your profits into ensuring the values, just in case we have a whipsaw to the downside. And then, of course, the last thing might be to lighten up on the stocks themselves and replace them with call options, which would have limited risk. And you could even buy a leap, see how the prices are. All these strategies, you've got to price out. You got to see if they're appropriate for yourself. You got to see if there's any dynamic to it that would be a negative, such as a tax consequence if you got called away or something like that. And so there's a lot to learn. But if you have any questions, I'm more than happy to give you a hand with some of them. And you simply have to shoot over an email to OptionProfessor@gmail.com, and I'll be more than happy to try to help you with it. Okay. All right. Now, so we see where we are, and that's where we are. Now, why would I be even thinking that it's possible we could roll over? Because let's look at the moving averages. They're still positive. Let's take a look. 200-day, 50-day, and the 200-day. 50 days at 2873. 200-day is at 2775. So they're still in a positive mode, and they're still underneath the market. That's not bad, right? But if things start changing, there's a lot of people who obviously are in this market. And if they all decide to sell out at the same time and the volume gets heavy on one side, you'll notice on many stocks, the volume has been lighter on a 50-day moving average than on a 200-day. So if this thing started to roll over with big volume, obviously it could go into a pretty sharp drop. So you have to be careful of that and keep an eye out for that. There's no evidence of it right this second, but there are some hints that might be telling us something. One of them might be the transportation average, which today was down more, but it did close down 42. And as you can see, there's the high on the transports, right? And look at these highs, lower, 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 right? So the transports have not confirmed any kind of a new high on the S&P. The other thing that I'm looking at is the Russell. And the Russell is 2,000 stocks, and they, of course, are what? They are 2,000 mostly American stock, relatively small cap. Well, look, there's your high, 1742. Where's your high down here? 1600. And where's your high now? 1522. We blow out 1450, and that's not going to be very good for this. So the Russell and the transport have not confirmed to me that we are in some kind of a massive bull situation. And that has me concerned that people are getting a little complacent. Let's go take a look at the VIX. That was down to 1415 area. And where did it close today? 1528. Okay, it did go a little bit higher, 1640, but then it came back down. So, my feeling on the VIX is if it stays above this 15 area, that you still have a shot that it's going to have a turn and start going after 20. If it goes after 20 or goes above that, then going into a very sharp decline, as we saw back here. And what time frame is that? December, right? Remember December? Well, once you get above 20, it opens the door to some volatility. And even in October, when you roll over above 20, you can get volatility. So be careful if it gets above 20 that the volatility doesn't become very substantial. Okay. Now, likewise, if it breaks under 15 and starts going down towards 12, we're probably going to break through 29.50 and go to new highs. So, I think we're coming into a very big crunch time, and I'd be on my toes if I was out there looking at the market, seeing about the market, being involved in it, and wanting to know how to protect or do something with my equity. With regards to other things going on, all right. Again, some of the stocks that had been running quite a bit, like Adobe Systems and some of the clouds, they had a little bit of a rollover here, and today they're doing the same thing. So as you can see, if you look at some of your big cloud companies, they had big run-ups, but they look like they might be rolling over. So you got to be a little careful of those. I'll give you another one here um, in uh, Salesforce. And Salesforce in the where are you? 150 area. Okay, you can see that it was up in the 160s, 170s area, and then boom, it's starting to come off a little bit. If it broke under 140, that might not be so good for Salesforce. And then Nvidia is another one that was doing pretty well, and that seemed to be giving it up a little bit here today too. Down at 44, but let's look at what the price action has been. Yeah, you see it had a rally, way nowhere near its highs, and then it had another rally here up towards 150 and change, and now it's backing off a little bit. So again, there is some things that are telling us that things are slowing down a little bit. And again, the earnings, the valuations right now, you have to be very careful of. Why? Because the valuations are indicating a little bit frothy. Why are the valuations so high? Because people are expecting the Fed to do all this cutting. If the Fed decides, listen, we're not going to do a lot of cutting while the numbers are not that bad, while unemployment is extremely low, while the stock market is within shouting distance of its high, because one of our dictates or one of our goals is not to pump up asset values and make them nutty and then have them crash and then have everybody come to us and ask for bailouts like they did in '08, like they did in 2000. That's what happens when you create an asset bubble and then you pop it. So the Fed is not in the business of asset bubbles, although you would think not because of all the asset bubbles that have been created under their watch. But again, they are very well aware that if the corporate bond market and the debt market, which is just frothed with excess right now, that if that ever did pop, there's no liquidity for that kind of stuff. You've got 10 trillion, $12 trillion of negative yielding bonds over there in Europe, and the bonds are making new lows, minus 24, minus 0.24 is the yield, which is like not even getting your money back. And then things like triple Bs, which is only one level away from junk, and everybody who's in triple Bs using those for investment grade portfolios. If they go down one level, they got to dump them if their mandate says investment grade only or not. And there's 10 trillion in that. And then of course the entire junk market is huge. And while these rates are low and people are hungry for yield, Tom, Dick, and Harry is issuing a lot of debt. So there's a bubble to be had there. Hadn't happened yet. Some people say it's not going to happen, but the spreads between treasuries and high yields are extremely tight, which means people don't even care about the covenants, just trying to get the better yield. And of course, when people get into that mentality, I don't think it ends so well. So you got to be careful of all that and then see what you think. All right, now I'm going to go into a couple of other things here. Right now, I'm going to go into the dollar, because people have been pounding that the dollar is going to have a big drop. And again, I've been telling you different in that the dollar's in a trading range. And today it was up pretty sharply. And it's been about 98 and change and 95 and change, and actually 96. So again, if you want me to get bearish on the dollar, I got to see it break 95, 96. and then I'll start buying into it. Right now, it's going the other way. Again, strong dollar you wouldn't think is good for gold, and so again, I've been a proponent of the gold and at the gold mining shares. I have been warning people that this area around 23 to 24 is resistance in some of the gold miners. And if you look at the juniors, they have not even nearly taken out their high. And today has a stem. So the excitement on the gold, with the inflation number still under wraps, and with the what do you call it? And with the dollar being so strong, I would be a little careful of chasing it right this second. Tudor Jones is in there. He's talking about what that he loves gold as a better investment for him for the next 12 to 24 months. Money started screaming into these ETFs. You know, you might want to cool it a little bit, see if there's a pullback, and see if it's not going to just go through the roof. Because let's take a look at the price of gold. I know it broke 1350 today, and let's just see if I can get a contract on that. Okay. Well, let's just look at the GLD, and that will be good. All right. The GLD 12 actually closed down on the day after being up at 127. So it did go up and make an all-time high, not an all-time high, a 52-week high, right? But it did close off. So that, again, I'm trying to warn people that it might not be great to chase it right this second because it's had a big run. The dollar's still strong. The inflation numbers may pick up. Why would they pick up? Because this tariff game that's being played, that's being sold as this great deal for America because it brings on all these tax revenues. Well, I mean, you know, it's bringing in revenues, but what they're not telling you is they're paying out more than that possibly in subsidies to the farmers and other people that are getting whacked by them. So, in other words, if you bring in $10 of tariff money, but you spend $15 in fixing people that have been getting whacked by them, you're not getting very far ahead. So, there's not very much talk about how much the expenditures have been. Okay. And that's really why I don't like, my opinion is the use of Twitter all the time, where you have one sided conversations with people and you don't get anybody to ask a question because it's a one sided deal. So the tariffs obviously do bring in revenue, but they do possibly increase prices to the consumer. Okay. And also, you have damage that you have to pay for, like the farmers. And if those damages exceed what you bring in, they're not as good a deal. Everyone knows we've got to strike a better arrangement with China, and everybody knows things have to be done. But again, some of the methodology here is not without consequence. At any rate, if you're looking for inflation to pick up, if you have a hope of that happening, it will probably be happening after these products and services start hitting the market with the tax included. And that is just beginning to happen now. So that's why this third quarter can get messy if the economic numbers start showing what? Higher inflation, okay, and slower economy because earnings don't go up in the second quarter when they start getting announced. And is Broadcom a one-off, or is that a precursor to revenue drops and revenue forecast drop? That's what makes the market a little dangerous up in this neighborhood. Okay. Now, things can go the other way. I've been in this thing for decades. I'm the first one to say I could be dead wrong, but here's how the tea leaves are looking to me. So basically, on the gold, you have to be a little bit careful up here because it's run up very fast, very far, and the dollar's still strong. On the stock market, the 2900, 2950 area still is intact, and we're going into a week that could have some news, and also we're coming into the end of the month with that meeting. So there is stuff coming up that could affect it, and of course, the second quarter earnings are going to start coming out. Again, if Broadcom is a precursor or a indication of what's going to be happening, that's not very good because we are looking at what valuations are pretty rich, and if the Fed doesn't drop the rates next week or in the month of July, you know, it could be a situation where we do get a drop in the third quarter, and then the Fed can ease, and it'll look like a normal thing to do because the actual markets and the economy is showing some weakness. Again, even if they drop it a quarter or a half, don't forget the 10-year note. Let me show you that so you get an idea when I say a lot of this may have been discounted. Hold on a second here. And the enthusiasm for lower rates, I don't think I've seen it any greater. Well, I've seen it the other way great, and that was in December when everyone said rates were going to go up this year. Now they're going the other way. Now the rates have gone the other way. Here's your 10-year note. Okay, so since December, when he said he was going to stall, we've gone from 3.25 on the 10-year, 3%, all the way down to where we are now, 208. So that's what, over a point and a quarter of drop in yield. Okay, and the Fed funds hadn't gone down at all. So what are we saying here? They've already discounted quite a bit of the drop of interest rates from the Fed because look, the thing's already down. Again, and now everyone's saying it's going to 1%, 1.5%, 0%. Okay. So again, you've had a big drop, it's already happened. And now you got to be careful that A, inflation comes back a little bit with these tariffs. B, the retail sales don't dry up, and 70% of the economy is people buying things, and that these people, are getting extended down here. And if everyone is short or long, and they all want to cover, well, that's a lot of situation where, things can get a little bit spiky. And so going back up towards 250 may not be out of the cards if, in fact, there's a reason to sell bonds. Because again, there's a lot of people long bonds. They all rent back in and they're all long the market. And I said something about shorting. What I meant was people are long the market. And if all the people long the market want to get out and people don't want to buy a 2% yield, then obviously you have a vacuum and you could snap back a little bit uh, uh, on the yield. And that is not off the table as far as I can see. Again, I could be wrong. They could be lowering rates next week. The 10-year could go to 1.5%, like people are talking about. But since everyone's talking like that, similar to how they talked in December, I'm suspicious that that's going to happen. Okay, so a couple of places where people have been hiding. Let's see how they're doing. They've been hiding out in utilities. I'm going to look at the Vanguard Utility Index just to see what's going on there. And the Vanguard Utility Index is back up today. So obviously it's a risk off kind of feeling, and it's not very far from its all-time high. So getting about 3% yield on this thing and having that type of growth has not been a bad place to be. The other one people have liked is the REITs, and the REITs over at the Vanguard, and these are just examples. Vanguard has them. 9 million of these REITs are out there. So go look at any one you like. I'm just showing you this as an example. But there you go there, 90-12. That's a 52-week high on the REITs. So they're going back into the defense. And that pays right now, according to the screen, about 384, but that's not a guaranteed thing. And then basically we went from 70 almost to 90. So it's 20 bucks on 70. That's a pretty good move since December in something like a REIT. So those are two where people have been hiding out. And basically, the people have been pretty happy with that. A couple of Chinese stocks keeping an eye on. Alibaba went all the way down to 130, and then it popped all the way back up to 200. And then oil dropped, right? Big oil drop, and boom, look at this, same drop as oil. And now you're looking at what? A bounce back to 165 area, and now we're back to 158. So we might go down and fill that gap. If we don't take out 150, though, I'd keep an eye on Baba. This is an enormous company with a lot of different ways to make money. And so, I'm definitely a believer here. But with the headline risk out there, you've obviously got to be careful. But 32 to 1 PE ratio, 158 on a company that is $500 billion almost. That's not too shabby to keep an eye on, especially if you want exposure in the emerging market area. Then one other thing people are keen on all the time is banks. And let's take a look at the banks real quick. Now they were up a little bit. Be careful what you wish for. Everybody wants these rates to go way, way down, way down. And I just wanted to show you. Rates in Europe are very low. In fact, they're negative in Germany, right? Well, this is the biggest bank in Germany, and you'll notice that I'll show you how negative yields have worked out for them. This is going back 10 years on Deutsche Bank, and that gives you an idea of the kind of deterioration that can happen here. It used to be in the 60s, then it was in the 50s, and it's in the 40s, and it's in the 30s, and the 10s, and the 20s, and now it's at about $6 and change. There is one. People think these European banks may have some value to them because their valuation of book to price to book is like 20 and 40% versus where a Citigroup and J.P. Morgan is, which was between 1 or almost 2 times book. So you can see when you get down to 20%, boom, that's a pretty discounted price. So, some of these things, it might be darkest before dawn. That's what made some people, interested in the preferreds on on Deutsche Bank, and this is a preferred that's trading at 25.85, and it was yielding when I last talked about it 7.9, almost 8%. Now the yield's down a little bit because the price went up a little bit, but this thing has been hanging around 24, 26 for a long time, and it pays a pretty darn good yield. So I don't know if I was going to look at Deutsche Bank, I might not be unwilling to look at the preferreds if I didn't think they were going to go down to zero, and if I didn't think the company was going out of business, then I would probably take a look at this only from the standpoint of the yield's pretty darn good, and it has been fairly steady despite the decline in the stock. So maybe they're overdoing the stock, maybe not. All right. It is time up, and I'd like to just thank everybody for being here today. There's a lot to cover, and 30 minutes is very tough. So if you have any questions on the market, any questions on your things that you're looking at, any questions on how these different option strategies may or may not work, and what's the use and the risk of them, simply shoot me an email, optionprofessor@gmail.com. OptionProfessor.com. Don't forget to tell your friends that if they want to get an update on the markets, to tune in once a week to OptionProfessor.com and get the link and tune in for next time we're with you. Okay, it's Friday. Let's go have some fun this weekend, and got a big week ahead of you. And that market right around 2,900 is not going to last there forever. So stay tuned, and don't forget to tune in next week when we get together. Have a great weekend, everybody. This is Jim signing out.